Very good. Everybody can see that okay and hear me okay, right?
Yes.
All right, awesome. Well, thanks for joining everybody. Let's first of all, I'm going to show you the formula. It's we're going to look at doubling the earnings, doubling the growth or the revenue level, and then doubling the multiple expansion, which is the earnings multiple that your company is worth because you have high earnings and high growth, et cetera. And that's how we get to our 8x. And I'll walk you through everything and kind of give you a playbook of that. And these are the 6 steps. The very first step is to start with a valuation analysis. We want to get a baseline of what your business is worth in order to get started on this process of dramatically improving the valuation. So a couple things about valuation methodology, and some of you are fairly sophisticated and will know this. Others, it may be somewhat new, but I'll just walk through a few things. Most businesses are valued as a multiple of earnings, especially manufacturing businesses. There are some business models that are valued on a book value and some business models that are valued on a revenue multiple, but almost all manufacturing companies are bought and sold based on an earnings multiple. So that's just a multiple times your earnings. And it varies by industry and business type, even within manufacturing, all the different manufacturing sectors. And I'll show you some examples of that. And then even though there's average multiples and average deal structures, there's of course premiums and discounts based on the overall view of the quality of the business by the buyer. And in most cases, an owner is going to exit to a private equity firm or a larger strategic acquirer. And so we're going to be talking about, exit values and sort of M&A. Let's talk about how a typical valuation would work. Just taking an example of 5 million in revenue, netting out the expenses, getting to net income, and then we're going to add back interest, income taxes, depreciation, and amortization to get to EBITDA. EBITDA, for those of you that don't know it, it's earnings before interest, taxes, depreciation, amortization. It's basically cash income. Why buyers focus on EBITDA is if I take these 4 line items, as a buyer, it doesn't matter to me how a seller capitalized their business, whether they used equity or debt. I want to look at the cash income and then I'll apply how I'm going to capitalize it, and I'll know what my interest rate is or what my cost of capital is. So I want to neutralize that, take that out by adding that back. Same with income taxes. I'm going to have a different tax structure than the seller will. Maybe the seller had a pass-through entity like an S Corp or an LLC. I might have a C Corp. So I'm going to look at my taxes. I want to know what I'm acquiring in terms of cash net income without any kind of taxes in there. And then, of course, depreciation and amortization are non-cash expenses. I'm going to look at what I need to do for CapEx, what that might drive in terms of depreciation and amortization, but I want to add that back. So almost all deals done for all manufacturing companies when you exit will be an EBITDA multiple. So, and let's just take an example of, let's say that multiple is 5x. Then the enterprise value is simply 5 times EBITDA, or in this case, about $4.6 million. Now, that's the enterprise value. So that's the value of the entire business, inclusive of debt, excess cash, and all that. So to get to the equity value, which is the amount of the value of the business that you own as an owner, we have to subtract the debt. And then we either we add excess cash if you have excess working capital, or if you're short of working capital, that'll be a deduct. But there's a kind of a balance sheet test is what it's called to make sure there's sufficient working capital when you sell the business. But let's just forget about that for now. The main thing is your enterprise value. We have to take away the debt to get to equity value. About 80% of all manufacturing businesses have debt, so that's going to be a common thing to subtract the debt. All right, so that's how the valuation basically works in terms of the earnings multiple. In this case, we've got purchase price multiple at 5x. I just took some example manufacturing businesses, 6 different examples, different NAICS codes, just to show that how the differences in how these deals are potentially structured, as well as the EBITDA multiple. So this is from Deal Stats. It's hundreds of thousands of transactions that actually happened where all the details are entered into the database and reported on. So you can see, for example, a manufacturer electrical components, an average EBITDA multiple of 5.2 and so forth. Now, I also want to point out that the percent of cash at close, the percent of the seller note or earnout, and employment agreement, these are important parts of a deal structure. So not only is the EBITDA multiple different in terms of the value of your business, but depending on the type of business, for example, a lot of services businesses where the owner and their reputation is really involved in servicing customers, writ large, the average cash at close for services businesses is only 60%. And the average employment agreement is closer to 80%, where that seller is forced to stay on for another 5 years, continue to run the business to make sure the customer relationships stay in place. With manufacturing and shipping products and through distribution and to wholesalers and retailers, et cetera, in the marketplace, there's less risk of that. So you can see the cash at closing is higher, but even within just these six examples, you see differences in the percent cash at closing. And then a seller note may or may not be reducible. Earnout is always a contingency. And so again, with earnouts, we don't see a lot of earnouts in manufacturing in general. In other businesses like services businesses, an earnout might be as much as 25% of the deal because you want to make sure customers stick and the services work and all that. So I just wanted to point out kind of overall valuation multiples as well as deal structures. And again, these are averages for all businesses in these NAICS codes and according to the deal stats data, just to kind of give you a baseline of how that works. All right. And then in terms of the kind of things that will affect overall valuation, on the left side, we have a lower valuation and more contingencies. On the right, higher valuation and fewer contingencies. So a company in general with a higher level of earnings. So in other words, if you have 15% EBITDA versus 5% EBITDA, in general, you're going to fetch a higher valuation. You're a higher quality business. And in general, that business is deemed to be safer and there's going to be fewer contingencies. It's like, hey, you're outperforming, you have for years, fabulous. That's going to drive a higher valuation. And the same with just the level of revenue. Bigger companies get a higher earnings multiple. So all things being equal, even at the same percentage of earnings, just because you have more revenue, it's a safer bet. You've got more earnings on a just a relative basis. That generally fetches a higher multiple and the type of revenue. In fact, I've got like, recurring revenue gets a higher earnings multiple than non-recurring revenue, right? It's more revenue visibility. And so buyers will pay up for that. And more revenue gets a higher earnings multiple, as we mentioned. And and by the way, in terms of valuation as a baseline, you can get a free valuation. I'll show this at the end as well. But here's the QR code for an analysis that gets you valuation, capital availability, a bunch of stuff that we're talking about is free for FING members. So there's a bunch of things here that drive the evaluation premium versus a discount. A lot of this is quality management team as well. If you're a seller and you're trying to sell your manufacturing business, you have to have a really good team in place to run it as to allow you to retire. And if not, that's where you see the owner staying on in an employment agreement, et cetera. You get the idea. Lots of things affect the valuation. What we're focused on in this webinar is the core things to drive a significant valuation increase and how to do that. All right, the next step then is the profitability analysis. Now, we've done the valuation analysis. We have a baseline of where you're at. The order of this is really, really important. Now, many advisors focus on growth. And, I get tons of spam email. We can help you grow. Would you like more sales appointments? And a lot of advisors focus on growth. But growing just for growth's sake without knowing which products are profitable, which customers are profitable, et cetera, is a real mistake. And we've all had those experiences of seeing high growth, but a lack of profitability growing at the same level. So we're going to focus on profitability first before we get to growth. And growth, you'll notice, is step number 5. Okay, in terms of profitability, we want to basically lay out the roadmap for you to how to improve profitability dramatically. This is, I've acquired a lot of businesses, started a lot of businesses, and invested in a lot of businesses, and advised a lot of businesses. This is the most extreme example in my career of a business where the focus was on revenue and not on earnings. This is a real business. These are real numbers. So you can see they basically grew from under 10 million in revenue to 50 million in revenue over the course of 20 years. Net income in 2020 was only 150,000. So a few of those years they lost money, and most of them they barely broke even. The total focus of this company was revenue growth. And you can see the level of CapEx. It was 40 million of CapEx over those 20 years into manufacturing equipment and their plants and distribution centers. And they only pulled back out 26 million over those same 20 years. So obviously, this is a losing game. Notably, this is a third generation family office that owned this. These are a group of cousins that manage the family office and several businesses within the family office. This was the very first business their grandfather started, and there was emotional attachment to it. But I'll walk you through and use this company as an example of some of the ways to dramatically improve the profitability of a manufacturing company. Okay, so typical profit leaks in general is that focus on revenue rather than net profit. Oftentimes you'll hear a business owner say, "Hey, I just landed $1 million customer." They rarely say, "I just landed a customer that's a quarter million of gross margin." And they'll never say, "And I figured out the net profit and it's only 50,000. I'm really disappointed," right? So we want to try to shift the focus from revenue to net profit by allocating all of the expenses properly to all the products, all the customers, all the sales reps, every demographic you can think of. So a typical profit leak is not allocating those costs and not understanding all the different cost drivers. And we'll talk through this and how it works. There's usually a lack of pricing configuration. I was guilty of this in my one of my corporate jobs when I was in a manufacturing division of ExxonMobil. At the time, it was called Mobil Corporation. And I would get called from a sales rep, "Hey, I need to do it like take our core product and tweak it, customization." And I would just kind of wing it and just say, "Yeah, sure, we can do that," right? I didn't understand all the things in operations that would drive all the cost variances and properly price that customization. And a lot of times I see that in manufacturing environments. So that's a big profit leak. Another one is just product line proliferation. Over time, with custom products can become standard products. There's different types of packaging of different products, and you just generally try to please the market, especially if you're revenue focused and sales oriented. You tend to just produce more and more products, and you have this proliferation of products. And oftentimes, manufacturing companies will end up financing customer AR and kind of bank their customer, right? So accounts receivable is a big deal. It's a big profit leak because it costs the company in terms of interest charges and bank fees and so forth to support that. And a real critical problem is the feedback from operations to sales. Because in an environment where you're trying to grow revenue and you have a bunch of salespeople in the marketplace selling, and they want to do whatever the customer wants, right? And I'll explain a couple of things that happen in this particular company that we're looking at. So here's some examples with this company that had that dramatic revenue growth, but no profit growth. They didn't capture all the costs to serve small customers. They have almost 2,000 customers, and some of them were very small. And just the whole cost of taking an order, packing the order, staging the order, shipping it out, all of that. And of course, it was, all LTL kind of shipments, not truckload. I mean, all of that kind of stuff. It was by the time, if they properly allocated all the stuff that's down in G&A, of course they had cost of goods sold and direct labor properly. But most manufacturing businesses writ large are about 50% gross margin. So that means 50% of all of the costs is in G&A, but all of those costs can be and should be allocated to customers, to products, et cetera, to really have a sense for what is driving these costs. Here's an example. They didn't properly, capture all the costs to run small lot sizes. So they would have the same SKU on a line, and they would be running this SKU, but there was an emergency customer. They have to switch the line and run a different product, and then switch back. So within the same SKU, they would have lot runs that sometimes it would run for weeks at a time on a very popular product. Other times it would only be half a day. The difference between just the lot sizes of the same product was 7.7x cost difference. And what I was encouraging them to do is any downtime, take the fully loaded cost of downtime, all the labor, all the overhead, everything fully allocated to each. So we basically ran all the overhead costs allocated to each line. And any downtime was allocated to the run to the right and to the left of that downtime. And so a small lot size absorbed half of the downtime, for example, to switch over, and just as much as a large lot size, because that's the way it works, right? You had to switch over to run this small lot. when we did that, it really helped them optimize switching, basically how they scheduled their lines, which they had never done before. Um, Another thing that they didn't do is they didn't rationalize inventory. And again, it's a part of that product line proliferation, which leads to massive amount of inventory. And they rarely looked at obsolete inventory or slow moving inventory. And over time, as it proliferated, there was many SKUs that were almost exactly the same with very few differences that could have been consolidated by simply feeding back to the sales force and to the customers to say, this is what we're going to do. We're going to, tweak our product lineup, if you will. Now, in addition, they had this is a food manufacturing company, so they manufactured food, and so they had this perishability issue. This is really interesting in terms of the optimization problem. So if they ran an SKU too long and had an inventory too long, right? They want to do a large order to, reduce the cost, right, of running a large lot. They now had too much inventory they ended up throwing out. So they didn't want to ever throw out inventory, but they also wanted long lot runs on the line. So it's a real optimization problem that they hadn't fully worked through. Some more examples is in some cases they had exactly the same SKU, but different packing requirements based on different retailers. And this is where sales would unwittingly just say, oh, sure, we can pack that 12 per box, or another customer, yeah, we can do 24 per box, et cetera. So the same exact SKU had all these different packaging configurations, basically customization, if you will, on top of their core standard product for various customers. So in watching, the lines running, they would frequently stop the line, switch out all the packaging and repack. And the packing was oftentimes by hand, kind of offline, slowing things down because it was custom packaging. And they never fed that back to the sales force in terms of, gee, can we take this and just reduce to where everybody gets 18, SKUs per box? Why can't we do that instead of having 6 different box configurations? Now, and this is also interesting. The cost of distribution was not really taken into account by anybody, especially the sales force. They had a separate freight app. And so, of course, sometimes the product was picked up, some was shipped, the LTL versus truckload. Some were shipped to their distribution center. They had warehouses, distribution centers, and they frequently did interplant shipments. So they only produced half of their products at one plant, and another plant 4 hours away, they produced the other half of their products. So if a customer wanted products from both plants on one shipment, they would price that the same as if it all came from one plant. So down under G&A was a large line item of interplant shipments that weren't allocated to any products, to any customers, any sales reps, or anything. Once that was allocated out properly, that really helped everybody understand how to greatly improve profitability. And of course, the sales force was commissioned on revenue instead of profitability. This is basically a global problem across any business. It's right. One of my favorite things to help a business owner do is to really kind of, once you understand profitability and properly allocated cost, to change the commission structure so that everybody's pulling in the same direction and focused on selling what's profitable. And the cost of all this they did a lot of customization with their products. And the cost of that wasn't priced in properly. It was often done sort of offline and wasn't ever allocated. And their line of credit was, larger than current AR and current inventory. So there was a lot of slop in their working capital, and that affected their liquidity, which I'll get to in a second. So here's a couple of just quick analyses for this particular company. So they had various segments. The number 3 was their retail segment, which they loved their retailers. And the other 3 segments were different wholesale segments. But if you look at their retail segment, now this is 3 years of revenue. We took 36 months of all of their data and did the analysis. So you might recall the initial graph, the revenue was about 50 million. So they were growing, but the 130 million is for the last 3 years of the company's history when we analyzed it. Look, you can see the revenue mix. The 60 million for retailers was a very large part of their revenue. They only made $350,000. I mean, it's almost embarrassing where it's basically like you're serving all your retailers for free. And so it's really eye-opening for them once we allocated all the costs, all the products, and then we rolled that into all the different customers and we rolled it up by segment. This provided a clarity that they'd never had before, where now they could take action on it. And this is by product category. So they had about 15 product categories, 2,000 different SKUs, give or take. I think it was 2,000, but within 15 categories. And so by category, most profitable to least profitable. So notice that we're always totaling up to 3.8 million. That's the total of what they their net income. So everything properly allocated means when I total up customers, products, product categories, sales reps, it's always going to equal the net income of the company for those 3 years. And so in this case, they could see that, several of their product categories were completely underwater on profitability, and some didn't have hardly any profitability. This is their sales reps. This was really stunning for them. 18 sales reps. One she delivered about 13 million in revenue, but 3.2 million net income out of 3.8. This one sales rep basically delivered almost all of the profit of the entire company, where several delivered some profit, and then several were negative, including one that was losing the company $1 million. So over the 3 years, this was a sales rep performance. This was super stunning for them because they were paying commissions by revenue. So sales rep number 5 was the highest compensated. Sales rep number 16 and 17 were really highly compensated. Sales rep number 1 was kind of in the middle of compensation, and she had a lower commission structure because of the structure of her customer. But it's like they didn't realize that she by herself was driving almost all of the profits. And so again, in this case, it's a roll up, right? So a sales rep's profitability it's the roll up of all the products they sold and all the customers they sold. And when we basically looked at every sales rep assigned to every customer, you could easily see what the net profitability was. Again, quite eye-opening in terms of what we need to do next. Okay, in terms of customers, they had 2,000 customers, just under that. Their least profitable customer was one of their biggest single customers. So their average revenue per customer was only 131,000. Their biggest customer is 8.6 million. They lost $1.5 million on that customer. And I see this frequently where a large customer gets really catered to, they're very large, they're very important. They ask for a lot of customizations, special treatment on, shipments, whatever it is. And the company bends over backwards to please them. But if we haven't allocated all of those costs of those kind of pain in the neck large customers, we don't really understand the picture. So this was really eye-opening that their favorite customer lost that much money. Now their most profitable customer was quite a bit smaller, 3.3 million, and they made $1 million on that customer. Way, way more important. And this helps reorient like which customers to focus on, right? And you can see the average profit per customer was only just under $2,000 on an average revenue of 131. And 41% of their customers were unprofitable. Now, we've done this analysis on hundreds and hundreds of companies. The average is 42%. Now, this is always a surprise. Most business owners will say, oh, there's no way that many of our customers are unprofitable. But again, when you allocate all the expenses properly, the truth comes out. Now, one thing that's really important in terms of this phase of improving profitability is really changing the culture. And in helping the entire company understand if there's any products that we're shipping that are unprofitable or any segments that are unprofitable or any customers that are unprofitable, that just gets in our way of increasing our profitability. We need to really take action on that. And the entire company needs to understand this. So our most successful companies that we've turned around, and it doesn't really matter if I'm the investor or an advisor, are the ones where the culture change was a big part of it, right? And a lot of that culture change is communication of, hey guys, this is what it actually costs us to serve, these small customers or these high demand customers or custom products. We need to be aware of that and feedback. So a couple quick steps in here, and of course you'll get a copy of the presentation, so I'm not going to go through everything. But the main thing is we want this baseline of profitability across the whole company like we've been talking about, right? And then we want to set a profitability goal. So here's another client example where they had 37 million in revenue, profitability was 15.3%, and net profit of 5.7 million. The valuation multiple for them was 7.2x. That means their baseline business valuation is about 41 million. I like to include this because it's a really good marker when we're focused on dramatically increasing our business valuation. That becomes the focus of what we're driving towards. Now, what I like to do then is pull in some benchmarks. So the average industry was 17.2. So in this case, the company was below that. The past high watermark for this particular client was 16.4%. If we just eliminated the losing customers, the customers that lost money, if we just, deleted them and made them go away, profitability would have been almost 27%. Now that's really interesting. If you just stop selling your unprofitable customers, you've already made a dramatic leap in profitability. And how about if you just move them to break even and just raise the price to where at least you're not losing money, but you're breaking even on them? That gets us to 20.5%. And if we just reprice to a minimum of 5% or something, it gets us to 21.8. Now, given this level of benchmarking, what I encourage business owners to do is set your profitability goal. So in this case, let's just say it's 20%. So now what that translates to, and we're just going to stay with the same multiple, is 53.9 million of business value. So just basically saying we're just going to try to move our losing customers and products to break even. We're adding 12.5 million of business value. This now becomes really encouraging. This is where now it's easier to make the culture change and everything else because, wow, we have a real goal. And this goal is very, very doable, going from 15 to 20%, right? Especially knowing what we know once we've done the profitability analysis. So then I just say, hey, let's set a profitability now that we have that goal. If there are products or customers above the profitability goal, we want to grow them. We want to promote those products, right? They're above that 20% in terms of net income, fully allocated. Great, let's grow that. If they're below, we want to change the spec, change the service level, reprice, or eliminate the offering. Take that SKU that's being repacked 12 different ways for 12 different retailers, change it into one, get it priced right. And now we know that product's profitable, but we want to make it at least 20% net income if that's our goal. We want everything to be at that level or higher in order to, move the company in that direction. And so but we always want to kind of rerun this. What if we change this? And then now let's rerun it and see what the impact is on business value. Here's an example, list of products or offerings, what the net profit is. And the action plan is either promote that product heavily, change the spec or reprice it, or eliminate it, right? Really simple action plan. Very, very doable in terms of a roadmap. And then we want to look at now now that we've improved the profitability of our unprofitable products overall, now we want to look at that basket of products or offerings that each customer buys, because that's going to change the customer profitability, right? That unprofitable product that we sold to that one customer that we've repriced or that we've eliminated, that's going to change our overall profitability. So now we're going to focus on customers, though. Overall, if a customer is still below our 20% goal, we're going to want to, either reprice that customer, change their product mix, or potentially fire the customer, right? We just can't afford to do business with you. And then kind of rerun everything again, look at the business value, and just keep doing this. And now we want to look at all our demographics. So now once we've improved the customer profitability, our sales rep profitability, our account manager profitability, our district, our regions, our divisions, whatever the demographic is that you're rolling up the profitability to, that all now changes. So we're kind of rolling this forward and redoing everything. And ideally now, as we look at sales reps and account managers, we're also changing the compensation plan based on that. So now if we've done all that properly, now we've got our earnings lift that we're looking for. Remember, in our formula, we're trying to double earnings. That's our earnings lift. Let's get a 2x of earnings. Now, in almost all cases, when I'm engaged with a company and again, it doesn't really matter if I'm an investor in the company or if I'm merely an advisor, a company can usually double their profitability, double their earnings in 1 year or less, because the clarity of what's going on, especially the simplicity of just get rid of your unprofitable products and unprofitable customers, or reprice them or reconfigure. Once you know this, it's a dramatic leap forward. So this will automatically get us that 2x if we work through that roadmap typically. And sometimes it's really dramatic. I've seen earnings lifts of 5x in 18 months, for example. It was one of the probably the best performances that I've seen of one of my companies. So now we're still not ready to grow. Now that we have everything that we know is profitable, we've fixed all of that, right? Now we want to look at our capital availability because it takes capital to grow. And we want to make sure that we access the lowest cost capital. And the first thing to focus on is improving liquidity. And liquidity is just the ability to turn assets into cash, collect that AR, sell that inventory, et cetera. Now, doubling profitability will dramatically improve our cash that comes in on the top of the cash flow statement, rise net income, that's going to double, and it improves our opportunity to increase liquidity. But we won't increase liquidity if our AR just keeps growing, right? So we want to make sure that we manage AR and inventory because those are the two things that really impact working capital and liquidity. And in terms of manufacturing, it's really the entire whip, right? It's everything from raw materials to finished goods and all the packaging I talked about, the special packaging and special pelletization. Oh my goodness. I don't know how many times I've been in manufacturing plants where they change the pelletization for certain customers. It's like, are you kidding me? We're even customizing how we stack it on the pellet and how we wrap the pellet because it's something on the customer end. And so all of this focus is going to help improve liquidity. And the implications are, and why we focus on liquidity initially is we don't want to finance a bad business model and we don't want to finance bad liquidity. We don't want to finance a ton of AR and a whole bunch of obsolete inventory and a whole bunch of WIP that we shouldn't be having, right? So we want to fix our working capital and our liquidity first. And liquidity has a huge impact on our ability to grow. So our plan to double growth is we want to double growth over 5 years. That's very, very doable. And so, but to do that, we need to finance that growth, and especially in manufacturing environment, if you're going to have, CapEx and grow your inventory and so forth. So the internal rate of growth basically says whatever money you leave in the business, whatever retained earnings is, divided over total assets, that's how fast you can grow without external capital. So you can see here in this formula, if you have 50,000 retained earnings left in the company and you have an asset base of $1 million, you can only grow 5%. Now we're trying to put a plan in place here in this roadmap to grow 20% per year for 5 years to double growth, to double revenue, right? So one word of warning is that rapidly growing ventures can often go broke on the balance sheet while still being profitable on the income statement, because if you try to grow at 10% rate, you're going to be in trouble. You're going to run out of cash. How we look at this, if we double the earnings, and let's just say we double our retained earnings, so we just leave 100,000 in instead of 50,000, and we get really good at collecting AR and reducing inventory, getting rid of all the obsolete inventory, rationalizing inventory, right, consolidating product offerings, et cetera, then that's going to reduce our asset base from $1 million to 500,000. If I just take out, all the manufacturing equipment and just focus on what I can easily change, which is my working capital equation, this then gives us a 4x ability to grow. We've changed our ability to finance growth internally from 5% to 20%. Now, 20% is what we need over 5 years to double our revenue. So that's good if we can get there. But if we still need capital, I wouldn't jump. A lot of people think, well, maybe if I just raise some private equity, that solves things. That's the last on my list. And I have several private equity funds, so I'm saying this also as a fund manager, is that if we not only do we not want AR to build up, I would love to see customer prepayments, right? It's the best source of capital there is. It means there's a happy customer. You got cash without costing you any equity ownership or without costing you any interest rate. So if you can get customer prepayments, great. If you can, on the other side of it, if you can extend vendor terms, great. An example is Amazon. When we order something from Amazon, they clip our credit card, they get cash immediately. Weeks, if not a couple of months later, they're finally paying the vendor for the product that was shipped to you, and they're finally paying UPS. I think Amazon famously pays UPS, 60 days later, right? So they are creating a cash cycle where cash first, expenses later. Think of that as extended vendor terms and prepayments combined. So those first two things, if you can get away with that, it's amazing. The more Amazon sells, the more cash they pile up. That's why they're so cash rich. Now, the third priority then would be unsecured long-term debt. Long-term debt, of course, is typically 5 years, maybe 3 years in maturity. It's a lower interest rate than short-term debt, like a line of credit. So you want long-term debt if you can, because it's going to be a lower cost source of capital. Unsecured, of course, because you don't want to have to pledge your oldest child. and give up their college fund in your house, right? And then fourth would be unsecured short-term debt, and then get into secured debt. And then if I'm looking for an investment, I'd rather get it from a strategic investor, like someone in the marketplace that really values what you have and wants to invest in that, because they typically are not as valuation sensitive, and you don't have to give up as much as of your company to get some growth equity. And typically they're not going to sit on your board or ask for a great deal of control. If you go to private equity, get a minority growth investment or some kind of private equity deal to help you grow, that's last on the list, because that's going to come with, they're going to want to control the board, control the equity class, have all kinds of preferences, and you usually don't want to go there until you're ready to sell and then sell everything. All right. So, like I said earlier, debt is about 80% of the capitalization of a manufacturing company. There's two primary sources of debt: earnings and assets. And here's a couple of rules of thumb. Of course, there's a lot of inputs that affect this and how a bank or a lender might view you. But in general, your earnings are cash flow based. Think of this as go to your EBITDA again, your earnings before interest, taxes, depreciation, and amortization, or free cash flow. But let's focus on EBITDA. Usually you can get about 2.5x of senior debt maximum. So up to that, right? So if your EBITDA is $1 million, for the full last 12 months, you can generally expect to get up to 2.5 times that, or 2.5 million. Now that's kind of the max, right? So, but could you get 1 million or 1.5 million or two? Yeah, you should be able to, all things else, being in line, right? Some companies want more than what they can max out on senior debt and go for subordinated debt. Subordinated debt will usually never be more than 3.5x total of senior plus subordinated. So the absolute max here would be 2.5 of senior and 1x of subordinated debt for 3.5x. So $1 million of EBITDA, you might be able to get 3.5 million of total debt at the very maximum, right? Now, and that's usually going to be, long-term debt. Now, assets, an asset-based loan is going to be usually predicated on your AR and inventory, and up to 80%. Oftentimes you'll see a lender that'll say, like, for your line of credit, we'll give you 60% on 60-day AR, 70% on 30-day, and 80% on current, something like that. But you can kind of count on sort of up to 80% of current AR and up to 80% of current inventory. A lot of lenders will say, well, let me look at your inventory. Why is your days outstanding, 120 days, right? That's what you got, a lot of slow moving inventory. We don't want to lend on that. So this is just kind of some rules of thumb. Obviously, a lot goes into to sourcing debt. And again, if you want, we have this valuation includes a capital availability analysis. So it looks at your financials and will tell you, windage and elevation about how much capital you could source in the form of debt by different type of debt source. Okay, so now we've fixed the profitability. We're confident that every product, every customer, we know all about profitability. We fixed our compensation plan for our sales force. We've got our earnings lift in place. We're now, we're double the earnings rate we were, and we've sourced the sufficient amount of capital, the lowest cost capital we need to grow. So now we're going to focus on growth, and we're going to grow confidently and profitably because we've done this previous work already. So in general, growth is expensive, right? We all know that any big growth initiative, especially for manufacturing, there's lots of CapEx for expansion. You have to add sales and marketing expense ahead of sales, right? There's a lot of investment that's made beforehand. So that's why we want to make sure we have enough capital to support this and still meet all our other obligations. Now, the warning from me is always that the easiest growth is the lowest profit growth every single time, right? It's sales reps are incented to promote, so they tend to drop the price. Customers are seeking bargains, so they tend to switch for a bargain, and it's just the lowest hanging fruit is the easiest growth. So that's why we want to make sure we understand our profitability, that we've properly commissioned on net profit, not revenue, and that we understand customers and customer profitability so we know who to go for. So the expression I like to say is know before you grow. So because we've done our profitability analysis, we should be able to confidently grow and focus on the most profitable offerings, right? We know what all of our products are now, what the profitability is, right? With the most profitable customers. And I like to think of customer segments or customer types or customer demographics, right? Like in the case of this food manufacturing company, retail was horrible. Like, and they kept growing in retail. It's like the more you grow, the more money you lose, basically, right? So you want to understand your customer types and who to grow with, and you want to focus on the fastest growing market segments. A rising tide lifts all boats. You don't want to be in a really dog eat dog competitive market where you're competing on price and trying to grow at the expense of competitors. Ideally, you're focused on fast growing market segments. And here's just some more details on that in terms of, and again, you'll get the presentation and so forth. I won't go into too much detail here, but what kind of offerings to focus on, what kind of customers to focus on. And again, you want to focus on the most profitable offerings or products, the most profitable customer segments. Work with your sales team to understand everything from values, competencies, and commission structure, and just in general, focus on building and growing efficient, scalable, and repeatable processes in your manufacturing environment. So a couple steps on the growth goals, kind of back to now our goals, right? We want to set this overall goal for the company. I like the idea of a 5-year plan of 20% growth per year, which again is very doable, and basically kind of look at your different demographics, divisions, regions, sales reps, whatever your demographics are, and each of them get a growth goal that adds up to the overall company growth goal. And everyone has in mind the impact of the business value and how you're going to drive that business value. And then look at your best customers in that kind of high quadrant of high growth, high profit. Who are those customers? What do they look like? How do you find more of them? How do you grow the business strategically? And so now if we've doubled the earnings, which we usually can do in a year, and we've increased our growth over a period of 5 years, we're now at a 4x increase in valuation. And next is the multiple expansion. Now, this is the easiest part of the 6-step process, because if you've done these two things, you almost automatically get a multiple expansion. In other words, your purchase multiple goes from 5 times earnings to 10 times earnings. Now, yes, your earnings have doubled and your earnings have grown 20% per year, but you're also getting the additional impact of a higher multiple for your higher earnings. Let me give you some examples. So remember this, how it affects kind of premiums and discounts. So you now have a higher level of earnings than the marketplace. You have more revenue than the average bear because you've been growing, 20% per year, right? Your historical growth is super impressive compared to the market average. That alone is going to drive a much higher valuation. I'll give you some examples, and these are some actual examples. Now, I'm not focused on the 8x formula here. I'm only saying point in time at a given revenue level and the average industry growth in earnings, what the multiple was. So the industry average for this particular company, as you can see, is, hang on, I got this thing. Yeah. So I just took the 15 million in revenue, which was the company that I was involved in. We had 15 million in revenue. Our earnings were 2.2 million. The average industry was 8.6% EBITDA. So we were at 14.4 in terms of earnings. Our growth is 21.4% versus only 2.2% for the industry. I want to point out one thing. I love this score. It's called the growth earnings score. So think of this as if I just add up the 2.2% for the industry average growth and the 8.6% for the average industry earnings and just drop the percent, that's a score of 10.8. So this entire multi-billion-dollar industry had a growth earnings score of 10.8. The company that I was selling we had a score of 35.8. So we were 3.5 times higher on a combination of our ability to grow and our ability to extract earnings while we are growing. So that's really impressive. In the PE world, in the private equity world, in a startup world, a unicorn is a startup that, in just a few years is worth $1 billion, right? In the private equity world, a unicorn is a company with a growth earnings score of 50, where there's some combination of 25% growth per year and 25% EBITDA, or 30, 20, or 10, 50, or something, right? If it's a 50, it's a wow. So in this case, though, at 3.5 times higher growth earnings combined score than industry averaged, I was able to sell the company for 10 times earnings rather than the average of 5 times. Now, 5 times was the average for the industry for 15 million in revenue. For that level of revenue, it was 5 times. That would have fetched $6.5 million based on those earnings, right? In this case, it was 21.6 million because we had more earnings than average and we got a much higher multiple. Now, the buyer in this case was a strategic buyer, and they wanted to take this company that was clearly outperforming the market and basically learn from that company to hopefully raise their growth rate and their earnings rate. So it's a strategic deal. So again, we're just focused on multiple expansion, taking a point in time of what if what if the industry average had the same revenue we did? What would be the difference in the multiples? Here's another one. So in this case, we had 250 million in revenue, and we had 20.9 million in EBITDA. Now, what's interesting is we acquired several businesses. So we grew from 125 million to 250 million in 1 year. So, and we had done that 3 years in a row. So our growth was 200% per year because we were growing by acquisitions, right? And so when we had acquired a business and stabilized it, rationalized everything, and got it humming along, we were extracting 25% EBITDA. But when a business we just acquired, we were acquiring businesses that were only 5% EBITDA. And so it took us a while to go from 5% to 25% because we were doing all that rationalization and profitability improvement, right? So what we were able to argue is, well, on a run rate basis, we can extract 25% EBITDA. And so we kind of did this pro forma EBITDA, right? But because we grew so fast, we haven't had time to improve it yet, but therefore we're worth 32x. So the same size of company in that industry would have fetched about a 12 and a half times multiple. In this case, we're about 2.5 times higher on the multiple because of our dramatic growth, 200% compared to 4.2%. And because of our ability on a run rate stable basis to extract 25% EBITDA versus 5.3%. And so note the growth earnings score 225 compared to only 9.5. Now, 32 times earnings is kind of a crazy multiple. Like that's a wow. But that's, if you look at the difference here in growth earnings and what we were able to perform at, that's what drove the multiple expansion. So this is what we're focused on in this segment is how do you get a multiple expansion? The ability to double your earnings, which you've already done in that first stage. The fact that you doubled the revenue in the last 5 years, and most industries writ large in manufacturing grow at the level of GDP, right? Kind of 3%, 4%, maybe 2.5% on the low end. So that's kind of the average industry growth. So if you can grow 20%, you are far outstripping industry average, and that's going to drive a much higher multiple. Okay, so now we've got our earnings lift of 2x. We've increased our growth over 5 years of 2x. And by doing that, that usually gets you about a 2x multiple expansion. And that's how you get through this 6-step process, that's how you get to your 8x in 5 years. Let me lay out kind of an example of how this might look in sort of a spreadsheet, right? So I took one of those 6 manufacturing sectors, aerospace parts manufacturing. Their average EBITDA multiple is 6.32x. Their average growth is 3%. Average earnings 11.3. So if you're a high performance company in the upper right, that's where you want to be. You're going to drive a higher multiple. Now, what's that growth earnings score? It's 14.3, right? We're just adding the 3 plus the 11.3, drop the percent, growth earnings of 14.3. So how do we get an 8x in this industry with this company? So here's what we're looking at. The average is, let's just start with 10 million. Let's just say we're starting baseline right now is 10 million. And the average earnings is 11.3, so that's 1.1. That's a 14.3 we just saw. And if we do our profitability improvement first and double profits, okay, now we're at 2.3, we're at 22.6%, and we're going to grow at 20%, not 3. What happens over 5 years? Now, this is what happens. Our revenue now is 24.9 versus 11.6. Our earnings is 5.6 versus 1.3. Our multiple is 12.6 versus 6.3. That drives a $71 million business valuation rather than 8. And so that's how the 2 by 2 by 2 equals 8x kind of roadmap looks like from just any kind of starting point or baseline. And so there's that QR code again for free analysis, which kind of gives you your baseline, your capital availability, your industry benchmarks, just gives you a whole bunch of analysis to help you get started because you're part of FENG. So with that, I will pause for Q&A.
Thank you, Wade. Do we have any questions? Jonathan, I see your raised hand if you want to get started.
Yes. Hi, Wade. Thank you very much. Great presentation. Could you make the connection between, you had showed the GE score, which looks like an addition of earnings growth plus revenue growth. I think one of the things that, maybe gets bad covered sometimes are PE companies who will come on board, raise a bunch of debt, go buy additional companies, maybe don't have the highest earnings on those, but that revenue jump then will lead to a jump in that GE ratio. So I guess that would kind of be a bad quality, right? Picking up just more revenue for the sake of increasing the multiple valuation multiple. So is there a connection between that GE combination? How would you assign more of it to earnings in terms of, like, I guess maybe I'm not being clear. What is the connection between that GE number and the valuation multiple that you're showing? Because there are several drivers of that, right? I didn't necessarily pull out of this what those exact drivers are.
Yeah, yeah, just in general, kind of think of it as a rule of thumb, right? So anytime, any combination is super impressive. So a lot of times the way in the private equity world we think about that is, well, if a company can grow 40% per year, and they've been doing that for 3 or 4 or 5 years, I know that that's expensive. They're running an M&A process, or they're really aggressively growing. So I'm okay with a 10% EBITDA, right? Because 10 plus 40 equals 50. So if it's still a unicorn to me. And in many cases, it might even be operating at break even, where they're basically taking every dollar of profit and plowing it into growth. And so there's 0-50. And so either way, it's impressive, right? And then there's other companies where, they'll have 35% EBITDA and only 15% growth. If I focus on the 50 again, right? And that's equally impressive to say, oh my goodness, look at how profitable they are. Oh, we got to come in and help them grow, and that's amazing. It'll be amazingly successful. On the other side, when it's flipped, it's like, oh, all we got to do is improve their profitability, but their ability to grow is amazing. And ideally, it's kind of balanced, right? But anything more than industry average is impressive. If you can be 2x industry average, that's super impressive. So if the industry is growing 5% and you're growing 10, and if the industry is 10% EBITDA and you're 20, that's amazing. Now that 10 and 20 is 30, which is a great growth earnings score, right? It's really hard to get to 50 or more. And that's why it's called a unicorn. It's like, okay, man, if you can pull that off, that's fabulous. But I go back to the industry benchmark and say, if you can be better than the industry benchmark on both growth and earnings, that is really impressive. And that's where you can argue that multiple expansion. I'm worth, way more on a multiple basis.
Yeah.
Does that make sense?
And for American manufacturing, are you seeing that 5 to 7 multiple range relatively flat, going up, going down? I mean, I know manufacturing is not as popular in the US as it used to be. Are you seeing, but now maybe with tariffs, it might be again. Are you seeing that 5 to 7 range kind of move in either direction?
Yeah, what's really interesting? I've been doing this for years, and across all industries, the multiples tend to be really, really sticky. Now, they keep creeping up slowly, like over decades. But if I look at like the last 5 years, there's almost no variation in multiples by sector, by industry, by anything. So it's a very slow moving dimension. For a long time, I always would kind of say, hey, any business is worth kind of 5 to 7 times earnings, writ large, big average, right? And that rarely moves. Now, when there's a lot of capital in private equity, it tends to bump up because deals get more competitive, and they tend to pay up because they've raised a big fund, and they have to allocate the capital, and they have to hurry up and invest. And they tend to be bidding on deals, right? So the multiple will fluctuate a little bit based on capital availability and capital inflows to private equity. What's interesting right now, in a high interest rate environment, private equity is not that exciting because you're tying up capital for years, hoping for a great return that'll beat the market. But if in a high interest rate environment, it's like, oh, are you kidding me? I can just put money away pretty safe, keep it completely liquid in a kind of an uncertain environment. And I'm going to trade off on betting on the private equity kind of return. So right now, earnings multiples are flat or even down slightly because of the high interest rate environment and a high degree of uncertainty. And because of that, less capital flows into private equity. Because there's less capital there's less capital chasing deals. Earnings multiples tend to go down a little bit. But when you look at multi-decades, it's just it doesn't change much. So you can well, that slide I showed with the 6 different manufacturing sectors, those are the big averages, for and it kind of does gel where it's kind of 5 to 8 times earnings is a safe range for any kind of manufacturing business, and it's not going to change a whole lot.
Thanks, Wade.
Yeah. Other questions?
Anybody else? Go ahead, Robert.
Hi, that's a great analysis. I understand most of it, and I'm sitting here and going, okay, this is great. What kind of systems, and this is a simple question, are you using to drive these analysis? Are you using, Sage? Are you using, I don't know about QuickBooks when it comes to this, but are you using multiple systems?
Oh, so accounting systems have the information, but don't have an easy button to press to get like the net
Yes.
in that, right? And so, I founded a software company that does that because that's sort of was a missing link. And that's the Profit Inc. company. So it's analysis that we do, which is it's quick and easy because we built all the algorithms and all the allocations. But yeah,
Oh,
it's one of those things that was missing in the marketplace. And so a lot of people prefer to extract all the information, build a data set, and use like a Tableau or something, which is great. I mean, a lot of B2B CFOs and a lot of financial analysts can do that. I learned to do this when I was at Boston Consulting Group. I worked with a $50 billion company and did this massive profitability analysis. And it was so cool when I was done. It's like, this is great. I'm going to keep this spreadsheet and kind of keep this logic, right? And then every time I've started a business or acquired a business, I've tended to go back to that. And so and then friends would say, hey, can you help me? Or, when I started doing private equity investing, you look at how to improve a business. So PE firms love to buy a business and then improve it, right? And so what I want owners to do is improve it before you sell to private equity, where you get the upside. But yeah, so I ended up just kind of taking all that analysis and building it out into an app to make that super easy.
that's great. Thank you very much.
Sure. Other questions or comments?
Just a comment, Wade. I've known the Profit Inc. model when it started, but this is truly a full complement. Excellent. From the perspective of working with customers, I've utilized different tools. This integrates a combination of the profitability and the details. You're familiar with Value Builder, which is a great tool,
Yeah.
but this kind of incorporates it a little differently. So, yeah, I'm excited to get this started.
Yeah, I like processes like value builders and EOS and stuff like that, where it's a kind of a good framework. And then I think I forget what step it is in value builders, but then it kind of says, improve profitability, right? And that's where you go, okay, how do you do that? Well, what I just talked through is kind of a roadmap for specifically one of the steps within value builders, right? So yeah, there's a lot of great frameworks and a lot of great consultants. And what we are trying to address here is just a really kind of that easy button that says, can I just push a button and just see this with full clarity to drive that, kind of, improvement in a business. Yeah.
Yeah, and more analytical to the numbers, which is what's needed. So,
Yeah.
Excellent job. Thank you.
Thanks.
Linda?
Other questions?
Yes, Chris, thank you. Wade, excellent thought leadership tonight. Thank you for sharing. Two questions. So I normally go after two easy areas, SG&A and COGS. SG&A, typical highest paid vendors either renegotiate the contract or get new vendors in that are much lower. And also COGS, tear apart your bill of materials. 9 times out of 10, the bill of materials is not accurate. The cost accumulation is not accurate. Where do those two components fit in this step process? Like, is it at the 1, 2, 3, or like, where does it fit?
Yeah, so within the profitability analysis, when we just do the baseline of, we're already taking the gross margin. So that includes the cost of goods sold, which is the bill of materials and direct labor, right? So that'll usually come out of the billing system or the accounting system, however it's set up. And then so that in itself is telling, because now at the gross margin level, you can see the profitability of your products, right? Which is really helpful in understanding, why are my COGS so high or my direct labor so high? That's usually fairly cleanly allocated. It's that other 50% of, like you said, not just SG&A, but all of G&A, because most manufacturing businesses are 50% gross margin. So we have 50% of all the costs of the company unallocated, and that's what we're trying to allocate. So what one of the things you said you focus on is, negotiating with vendors. That's helpful, but it's also helpful to say, well, let's negotiate with vendors. Great, get that done. But then whatever that cost is left, let's allocate that to every single product, every single customer, and let's understand what is driving all of that cost. I'll give you one example where costs can be hidden. So one of our companies that we were working with had 20 million in AR, and they had a whole bunch of interest fees, bank fees. They had restructured and renegotiated their debt 13 times. Every time was like a $150,000 fee, because they were busting loan covenants, right? So they had about 20 million of AR. And then when we look, so all of those fees were down in G&A, right? Their largest customer that they loved, that they never wanted to scare off, would do anything for them, was slow paying them 120 days. So half of their revenue slow paid 120 days. That amount of AR from that customer almost exactly equaled 20 million. So it's like, okay, you're financing a Fortune 500 company. You're their bank, basically, right? And all of those interest charges, all those bank fees, all that aggravation of busting loan covenants and all of that of their AR, 90% was that one customer. So 90% of that line item in G&A, all the bank fees and interest charges, was allocated to that customer as a percentage of revenue by customer location, right? So now we've properly allocated that. Suddenly, that customer that was half of their revenue was unprofitable. The entire customer relationship was unprofitable. And 65% of all the customer locations were unprofitable. That's the clarity of allocating something from G&A that's kind of hidden. It was like, hey, it's the cost of doing business. No. Another one is in a similar way was there was a bunch of CapEx charges if you look at the cash flow statement, you can see CapEx, right? It's like, where does the CapEx go to? Well, some of their customers required them to buy equipment and leave it on the customer location. Most customers did not. Yeah, they did not have a sales configuration tool. So whenever their salespeople sold, they always sold, hey, here's our price to do X. They didn't include the customization, if you will, of the service configuration of we need to do some CapEx and leave equipment on site. So there's all this CapEx on the balance sheet and flowing through the balance sheet and and the cash flow statement that wasn't allocated. The cost of that, of course, was depreciation and of course the senior debt that supported long-term investments. So when that's properly allocated, now those customers that required that, suddenly they're kind of popping up because they're, the profitability is dramatically less. And we now highlight the need to look when someone is going off script, right? When they want custom packaging of your manufactured product, or they want to tweak to the manufactured product, or they want something special like that, that oftentimes is hidden in G&A. We want to extract that, allocate that, which customers are, ate up this CapEx. So once we looked at the CapEx and said, can we allocate that by customer? Absolutely. We know exactly how to allocate it. That's an example of just that proper allocation. And what we've developed is, machine learning logic and AI to basically allocate by default almost all of G&A, right? Because based on what the item is, we have a default, algorithm to allocate. And then a few tweaks to that, and now we've nailed it. And now the company really knows full profitability down to net income for everything, and that's what's critical.
E-lighting.
Excellent, thank you. And just to follow on that, does your model change at all if you're dealing with defense business? Because you can't allocate everything when it comes to defense contracts.
Well, yeah. So what's interesting, so you're doing like a cost plus, right?
Yeah.
But you still have costs. So you maybe can't take that allocation and charge it to the DoD, but you want to charge it to that customer relationship within your company to really understand what it takes, right? Like some of those net customers are going to require you to, I remember one meeting, I had 13 people sitting in a meeting in New York City. And I'm looking around the room going, holy cow, this meeting is costing me hundreds of thousands of dollars. This is a really, really, a high need client that we flew in 13 people from all over the US. I'm like, no, I'm just kind of doing this calculus in my head, right? This is a very expensive sales call. But that's the kind of thing down under T&E that, usually doesn't get allocated out. But there are certain customers. I had customers that demanded golf outings, fancy golf courses. And if you add all that stuff up, that's what we're trying to allocate, the stuff that's not normally allocated. Does that make sense?
Yes, it does. Thank you so much.
Sure.